I want to welcome all of us to the Absa UPSA Law School Quarterly Banking Roundtable. This is the 12th in the series since we started about some 4 years ago. So on a quarterly basis, we try to constitute an expert panel to dissect issues relating to the banking sector in Ghana and sometimes even globally. This quarter's discussion is on the theme, Demystifying Interest Rates, the Monetary Policy Committee in the Age of Transparency. And like you may have seen in the posters and other publicity materials around, we have put together just the right panel to help us understand these issues relating to interest rates and how the MPC goes about its work and how it can even be made better. My name is Gertrude Amar. I'm a lecturer here at the UPSA Law School. Professor Bochi will be joining us shortly. He asked that I send his apologies because he's in an emergency meeting together with many of our faculty members, for which reason they are not here yet, but they'll be joining us as time goes on. So he's asked that I send a special welcome, especially to our guests who have joined us from far and wide, and of course to all of us as well. Without wasting much time, would want to start with our panel discussion.
Now go ahead to introduce our panelists. And the first person I'll introduce is Mr. Hassan Musa, and he is the treasurer at Stanbic Bank, Ghana. Welcome, sir. It's good to have you. Then the next person on our panel is Professor Patrick O. Esuming, and he is from the University of Ghana Business School. Welcome, sir. And the last person on my panel is Mr. Emmanuel Mensah, and he's a Director, Capital and Balance Sheet Management at Absa Bank Ghana Limited. Okay, thank you once again. And once again, good afternoon to everyone. And it's indeed a privilege to moderate this very important conversation. So today we tackle a subject that sits right at the heart of Ghana's macroeconomic policy and public confidence. And we're also looking at the role of the Monetary Policy Committee in an era where transparency is no longer optional, but essential. And as you know, interest rates affect all parts of our economic life. The cost of borrowing, the value of our savings, the stability of our businesses, and also government's own debt trajectory. So together with our distinguished panel, we hope to unpack the technical, the structural, and also the communication challenges that surround monetary policy in Ghana. And we'll also look at how the monetary policy decisions are arrived at and how it translates into real-world interest rates. So with that, let's dive right into the discussion. My first question I'll direct at Prof, and it's, how does the MPC determine the policy rate? And which indicators ultimately carry the most weight in that decision?
Thank you. Good afternoon. It's a pleasure to be here. So, even though our monetary policy framework is inflation targeting, what that means is that the Monetary Policy Committee has a medium-term target for inflation, which is to keep inflation between 6 and 10%. So that is the medium term. So within the medium term, the goal is to make sure that inflation is within that range. But when decisions are being made, it's usually an assessment to two main competing risks. The risk to inflation or price stability and the risk to growth. So it's always trying to weigh the balance, whether based on their assessment of the data, there's a higher upside risk to inflation or there's a higher downside risk to growth. So what it means is that if in this judgment, there's an elevated risk to inflation, you should expect to see a hike or an increase in the policy rate. If it judges that the risk to inflation is on the lower side, but there's a higher downside risk to growth, then you should expect a cut. So yesterday, if we followed, we noticed that they cut the rate by another 350 basis points. And that's because you see that currently the inflation rate of 8% sits right in the middle of the medium-term target. But when they are assessing, so what kind of indicator do they use to assess, to tell whether there's a higher upside risk to growth or to inflation? So for the inflation, they will usually look at what the recent inflation trajectory has been. Whether inflation is currently trending down or is trending up. So they will look at the headline inflation, that's the main inflation number we know. But they also have a series of what they call core inflation indicators, which strips away some of the more volatile items from the CPI basket. Then they will also look at, so the inflation is something that has happened, but the monetary policy also has to be forward-looking. So they have to look at events that are coming up and what they will mean for inflation. So, for instance, if there's an upcoming, say, electricity tariff hikes, then that portends for higher inflation going forward. Or if there's been a lot of liquidity in the system, then it just be forward-looking to tell. Then, because the economy of Ghana is extremely exposed. So Ghana's economy is one of the most exposed globally. So what that means is that the central bank also has to be mindful of what other central banks are doing to their rates. So for instance, if the US Federal Reserve or the Bank of England or the European Central Bank, if they are all keeping or cutting their rates, or they are heading towards rate cuts, then it means that we have bigger scope to also cut our rates. Because if they are raising their rates and we are cutting ours, then it means that investors, then their assets in their currency become more attractive. So investors will move there. So but they also have a measure of expected inflation, which is a lot more forward-looking. So they have a survey of businesses and some experts, finance and economic experts, who they survey to get a sense of what the expectation of inflation going forward is. So they will look at that. On the growth side, they will look at the recent growth history by looking at the recent GDP growth. But they also do have more recent or more frequent data, higher frequency data that tells us where the economy is headed. So they have an index called the Real Composite Index of Economic Activity. That includes information on cement sales. Cement sales, if it's going up, is an indication that construction and real estate might be doing well. And they will look at things like passenger arrivals. They will look at things like port activity. Or they will look at private sector contribution to VAT. It also includes retail sales. So if all of those, so that composite index, if that is showing upward trajectory, then it's an indication that the economy is heading to a strong footing. That means they will probably assume that, well, there's a lower risk to growth, and then that means they will put more weight on the risk to inflation.
Okay, thank you so much for that comprehensive answer. But I'll just ask you, in your view, do you think that is sufficiently forward-looking, their decisions currently?
Well, I think in the main it is. If you, at least, when you read all of those press releases, it's quite comprehensive in terms of looking at not just even domestically, they look at the global economy, what is coming up in the next quarter, at the very least in the next quarter or in the next half year, to get a sense. So in terms of what they are looking at, of course they could get better forward-looking indicators, but at least in terms of the thinking, it's not just where we are, but they are looking, because don't forget that the target is a medium-term target. So it means that you don't have to look at just the here and the now. You have to look forward. And so I think in the main, at least in terms of thinking, maybe there might be some limitations in the data, but in terms of thinking, there's sufficient evidence that they are sufficiently forward-looking.
Okay, thank you so much for that response. Then I'll move on to my next question to Mr. Emmanuel Mensah. And this is a question that most people are interested in. Why do our commercial lending rates in Ghana often remain high or elevated, even when we see that the policy rate falls? And so let us know, why is this disconnect, and why does this happen? And as he has mentioned, they've cut the policy rate. Are we going to see a drop in the bank lending rate anytime soon?
Thank you. Thank you very much. This is a topical question that any other person will want to understand. So I'll take my time. I'll try. Okay, and hopefully I'll be able to explain it better to you. So in Ghana, by regulation, commercial banks are supposed to price their loans off a rate we called Ghana reference rate. So the interest rate you get when you walk to the bank to go and get a loan is made up of two parts. The first part is the Ghana reference rate. We call it the base rate. It's the same for every bank in Ghana. As at end of October, that rate is around 17.93. That's the rate. That's the base rate. Okay? Now that base rate is determined by three variables. We call them, the variables are the monetary policy rate, the 91-day treasury bill rate, and then the interbank overnight rate. Now, the way it works, they don't have, not all the three have the same equal weight. So we have the monetary policy rate carrying 40% in that particular computation. Treasury bill rate carries 40%, and then interbank carries 20%. Okay, so apart from the GRR, we also have the banks also charge a premium over the Ghana reference rate. Okay, now for the GRR, anytime they cut the monetary policy rate, they will filter it through straight away. So yesterday's cut of 350 basis points, you just take 40%. Multiply by the 350, which is 140 basis points. In other words, 1.4%. It's an automatic. The banks do not have any control over it. So come the first Wednesday in December, you will see that the Ghana reference rate will fall. The good news is that the Ghana reference rate doesn't fall only by the change in the monetary policy rate. The interbank rate is highly correlated to that particular rate. So the chances are that the interbank rate is also going to fall. So it means that the 140 basis points I've given you, it may even be, there may be a further drop than that. It may even get to about 202 percentage points drop in the Ghana reference rate. Okay. Now the part about the premium, that does not depend on interest rates. It depends on, number one, the risk profile of you, the borrower. Okay, so you walk to the bank, you are working, you are a salaried worker, your salary passes through the bank. There's virtually no much risk in there. The bank knows that since your salary passes here, when you run away, your salary will still be coming here, so they could use it to what? Defray your debt. Okay, but if you walk to the bank and you are an entrepreneur, you want to start your own business, the risk to you compared to the person who is a salaried worker is far higher. The entrepreneur carries a higher risk, and therefore the bank will want to charge some premium on top of the GRR to cover that particular risk of lending to you in case you may not come back to pay the loan. Okay, so that particular premium depends on your credit profile. It also depends on the something we call NPLs, non-performing loans. Sometimes banks give out loans and then it goes bad, because there are some few people among us that have decided that anytime they take a loan, they will not like to pay. They are even among all of us. Your friend, sometimes they take money from you and they don't like to pay. There's an example of somebody who one day probably he will walk to the bank and take a loan that will not pay. Okay, So that particular aspect is a little bit sticky, because to tackle that, we need to change the structural stuff of the country. We need a credit scoring system whereby we will know your history of borrowing. Okay, currently we have, but we need to develop it more, so that when you walk to the bank, we will be able to trace you, that indeed you have gone to one bank A, you borrowed money from there, you didn't pay, and therefore you are coming here. We will be able to sift you out and say that no, we are not going to lend money to you. Okay, so because the banks are not able to identify these bad elements, the few bad elements, and what the banks generally will do is to charge a higher premium to be able to compensate in case some people do not pay their loans. Okay, so that's the reason why sometimes you see a higher monetary policy, a cut in the monetary policy rate, but you don't see everything filtered through to the commercial lending rate. However, let me just say that year to date, the central bank has cut monetary policy rate by, before yesterday's cut, it was about 550 basis points, 5.5%. If you look at the Ghana reference rate, it has fallen by 11%. And if you look at the commercial lending rate, it is also down 8%. Okay, so we are getting there. It doesn't mean that the transmission mechanism is not there. It is. It's just that the magnitude of the loan, of the interest rate on the loans people take is still high. But over time, give it a time, and then you will see that it will actually get to the point we will all be happy. Thank you.
Okay, thank you for that. So he's just explained that the factors that determine our commercial lending rates, it covers a myriad of items, so which the monetary policy rate is included. So it does have an impact. Thank you so much, Mr. Emmanuel Mensah. My next question I'll direct to Mr. Hassan Musa. From a banking perspective, how well do you think that the MPC is communicating its decisions? And is there any point where, as the theme is talking about transparency, too much transparency can cause or trigger some sort of unnecessary speculation or create some sort of market volatility? So do you think that the MPC is doing a good job in communicating, and how do you think that affects the way you react to the MPC rate?
Well, thank you very much for this question. This question is about my regulator, and I have to be careful the way I answer it. More so, you have lawyers to be sitting here. You guys with your long sentences, convoluted, therefore, subject to, and notwithstanding, and those things. I mean, the answer is yes, and to a lesser extent, no, and I'll explain. I think the Bank of Ghana and the Monetary Policy Committee reasonably communicates their monetary policy decisions very well. Why do I say that? They have this consistency in terms of how they schedule their meeting. We know, the banking system knows when they meet. Even before they do meet, they send out these quarterly reports that is public, that anybody, not only the banking system, anybody can read and be able to see what is likely to happen at the Monetary Policy Committee. And those of you who are bookworms here, you would have gone into the Bank of Ghana website and access these reports just to understand what is likely to happen at the recent meeting. Again, after the meeting, they release what we call the Monetary Policy Committee report. And then they gather the press and explain to the press, take questions and answers as to what informed the decision that they took. So they will explain to you what the global trends are in terms of risks to inflation globally, risks to growth, geopolitics, and locally the same thing, and how that impacts the local economy. That will culminate into the decisions that they will take. So for me, they are doing well, reasonably well, in terms of how they communicate their decisions. Having said that, there's still a bit of gap. I mean, there are times you would expect them to explain certain things explicitly and they will not explain. And I give examples. Pundits like Prof here expected the central bank to drop the rates a little earlier because they saw inflation trajectory. You are not only looking at the current inflation, you are looking at the inflation anchoring, i.e. expectation. So if the expectation is that inflation is going to go further down, and it was going, you saw them hold the rates so high. And what that did was that it kept lending rates, to your point, higher than they should have been. My colleague here explained that even though Ghana reference rate was coming down, you still maintain that it could have been better, it could have been lower. So it would have been lower earlier than it is now. So there's that gap that we need to fill. Now you also asked about over-transparency. That is to acknowledge the fact that our markets, especially the Ghanaian market, is not that deep and sometimes sentiment-driven. And so the central bank cannot afford to just be forthright in giving explicit information. There are times if they did give information as to, for example, the vulnerabilities in terms of the FX situation, it can lead to something catastrophic on the market, and so they would not necessarily do that. What I would say is that in solving what is the right balance, that's the key question. What's the right balance in ensuring that you are transparent at the same time you are not giving out too much information that will spook the market? I think they have to be clear in their communication, clear but conditional. So for example, we all knew, many of us knew that, look, this rate trajectory is going to go down. They would say, for example, if inflation is within this band, it's likely we would cut. They don't have to tell us by how much. So you know the trajectory rather than just what is, to avoid over speculation. I think that's what they need to do.
Thank you so much. My next question is quite related to what Alhassan has already said. So maybe I'll just a follow-up, you can hand over to Prof. So in terms of the transparency for the Monetary Policy Committee, do you think that it helps the public, or they communicate exactly why they make these decisions and not just telling us this is the decision that we've taken? Is it clear enough? Are they transparent enough? Do we know exactly why, or we are just told that this is it?
I think in the main, as Hassan has said, they do, at least there's a fair attempt to communicate exactly what is happening. So, like you mentioned, they do this press release where they give you a background of what has been happening, what the data is saying, and then they will indicate so to go and say, okay, for this reason, this is a summary of how we read the data. For this reason, we are going to do this. That doesn't mean that their policy is, or the decisions are always clear to people. I mean, there are cases where there are surprises. So I think that is where, there are a few cases where the expectation is clear that they are going to cut, and then they will either maintain or they will increase, and then you lose people scratching their heads. What's going on there? Because otherwise, if you give so before they do the announcement, they release a summary of the data, because summary of economic and financial data, and they release some charts alongside. Any experts who know how the decision is made, when you read that, without knowing the decision, you should be able to tell us what they are going to do. But there are one or two occasions where they make a decision and people are doubting. And then also sometimes the extent of the cuts or the increase. Yeah. So that one too usually sometimes contains some element. There are a few occasions where, not the current management, I think the previous one, I mean, especially last year, there were a couple of decisions where, I mean, from where I said that, I can speak my piece of mind. From where I said, it's look baffling. I think there was a point where, I'm talking about, I think it was March last year or so, where they introduced that tiered CRR.
Yeah.
So, you know, at a point where obviously they were concerned that the inflation was not really under control, and they knew that the NPLs were rising, but then bringing this tier CRR that seemed to punish banks for having a low loan to deposit ratio, it was quite difficult to reconcile. So, I mean, many of us thought that maybe it's just using the back door to, you know that this is where we are. You shouldn't be forcing the banks to give more credit. But then at the same time, you're punishing them for trying. So I think you have, once in a while, you have those things that makes you scratch your head. But in the main, I think, generally, when you read what is in the release, mostly it's consistent with what many people expect.
Okay, thank you so much. And CRR is cash reserve ratio, by the way.
So, I mean, we are dealing with students here, those of you who are interested. The point Prof has raised, which is the tiered CRR, which we did not expect as a banking system. I did write an article that is published. You can Google my name plus Bank of Ghana monetary policy. Just put monetary policy and put my name. You probably will see it and read it. It speaks to exactly what Prof is talking about. You know, at the point where they were, you know, trying to fight inflation by raising monetary policy rate to 30%. Mm-hmm. Now, at the same time, they came and said, banks that are not lending, we shall increase your reserving requirement. You will bring your money and deposit it with the central bank, and we will not pay you anything. It didn't make. I'll stop.
I guess you all understand what he's trying to say, right? Okay, thank you so much for your answer. Okay, so we'll move on to the next question. I'll address it to Mr. Emmanuel Mensah. And this is also about the commercial bank lending rates as well. So how do banks manage that balance between maintaining good assets or maintaining your asset quality at the same time offering competitive lending rates, especially when we have a lot of, you already mentioned, there's a lot of high NPLs in our economy. So how do you manage that balance?
It's a very tough job, okay. But the banks generally will do what we call the due diligence. Okay, so if you want to go to the bank to go and borrow money from them, they don't just give the money to you. The bank will try to ask some questions. They want to know the real you, okay, whether you have the capacity to pay. So they will ask of your, if you're a company, they will ask of your cash flow to analyze it, whether you are doing well or you're not doing well. And if they give the loan to you, whether you'll be able to pay. They will want to know whether the amount you are asking for is adequate, and therefore if they dispense that money to you, you will be in the position to pay later in the year, in future. So the due diligence they do will try to separate the bad nuts from the good ones, okay, and therefore they will give good rates to the good ones, the competitive rates to the good ones, and then they will give a higher rate for the people that are perceived to be bad nuts. Okay, so that's what they will do. Another thing that they also do is that, I said the pricing for a loan is divided into two: Ghana reference rate and then the premium that they charge. The Ghana reference rate, they cannot do anything about it, but the premium, they can do something about it. If they perceive you to be a very high-risk person, the premium goes up. If they perceive you to be a low-risk category, the premium goes down. In fact, as we speak, there are some banks that even lend at Ghana reference rate minus a premium to you. So at the 17.8% that I told you about, it's not always that the banks will lend above it. No, there are times if a good credit, the bank will actually take the 17.86 and subtract something out of it and give it to you as your price. Okay. The other thing is that the bank also takes care to cushion itself in case something goes bad, and therefore they will ask you for something like an insurance, a collateral. Okay, a collateral is an asset that you can use to pledge that in case this money I am taking, if I'm not able to take, I'm not able to pay, please you can go and sell that particular asset. In Ghana, for a loan to be considered as a secured, you have to 120% of the value of the security. So your value of the security must be 120% of the loan you are taking. Now, if banks are not so much, if they want to have a lot of cushion, what they do is that they ask for more collateral, so that the value, the 120%, they can ask you to put aside 150% of a collateral, so that in case the loan they are dispensing to you goes bad, they will have the right to go and sell that particular asset quickly and be able to give it on to you. So these are some of the things the banks use to segregate the bad nuts and be able to give competitive rates to their customers.
Okay. All right. Thank you so much for your response. Okay, I'll move to the next person. I'll hand over to Mr. Hassan. And we're talking about the interbank market now. So how do the liquidity conditions in the interbank market influence the commercial lending rates? And do these conditions allow the bank to respond meaningfully when the policy rate changes?
Thank you very much. So I hope we understand what interbank market means. Simply, this is a place, or this is a system where banks borrow and lend money from each other on short-term basis. In Ghana, roughly maximum 1 week, sometime, depending on the relationship between the banks and the arrangement, it could be a month or two, but it's almost always overnight, maximum 1 week. So the question is, how does that liquidity on that market influence lending and borrowing? So to the extent that there is more liquidity, the interbank is awash with liquidity, almost every bank has cash sitting on their hands. It affects, banks are actually, comfortable to lend. Why? Because if you lend and you run out of liquidity, you have the next bank that you can borrow from. On the other hand, if liquidity on the interbank market is dry, banks are quite conservative in their lending activities. But let me note that interbank market is not where most banks that are worth their salt, want to rely on to lend. They just rely on it for short-term liquidity. Remember how banks work. We take your money, all of you, I believe all of you have bank accounts, and you have current accounts where you put in money, the next day you come and sweep everything. It's not reliable, but on the back of these monies that we keep for you, we can lend to others for 3, 4, 5 years. So if the next day you show up looking for your money, how do we get the money for you? We have to look to the next bank that has liquidity and borrow from that bank for a day or two to get you to have your money. That's how the bank market works. So you cannot, as a bank, rely on that and start booking loans. You must have your own deposit, but just rely on that for short-term things. So to the extent that there's so much liquidity in the hands of banks can now feel comfortable that if I run out of liquidity for a day or two, I can get the next bank to give me to be able to do whatever I'm doing. Same is true if there's no liquidity on the interbank market.
Okay, thank you. And just a follow-up. So post DDEP, how's the liquidity on the interbank market? Has it improved?
Well, it has improved. Remember, the reason why we have the monetary policy rate so high at some point was because, not necessarily because inflation was so high. After DDEP, banks were not actually lending, and government wasn't borrowing, remember. And so most of the deposits that came to banks were just sitting with banks like that. No treasury bills, the short-term treasury bill was there, apart from that. And even that some banks were wary of putting so much because, I mean, their fingers have been bent. But now, there was so much liquidity in the system. And one of the reasons why we have the monetary policy rate being so high was because of the liquidity. And you can see how much liquidity they knocked out of the system through what we call the open market operation. That has helped bring inflation to where it is at the moment.
Okay, thank you. Thank you so much for that response. Okay, Prof, I'll come to you now. You mentioned inflation targeting earlier. So my question is, how should MPC balance its inflation targeting mandate with the day-to-day challenges faced by the ordinary Ghanaian households and businesses, especially in a high-cost environment?
I think it's a delicate balance, but it's an important balance. Even though, so if you take other regimes like the US, the mandate of the central bank, the US Federal Reserve, is clear, it's dual. It's price stability and promoting of employment and output. So that one is written in the law. In our case, we don't necessarily have that dual mandate. So we have an inflation targeting regime, but it doesn't mean that all the focus should be on the inflation to the detriment of everyday economic activity. So I think it's a very important balance, and as I explained earlier, that's why every time they are making the decision, they are weighing the balance. I think in some sense, you could say that some regime or the same country, some management, or depend on the individual, some of them are more risk averse towards the inflation risk. So there are some who are extremely sensitive to inflation risk. And then when that happens, it means that they want to keep the rate as high as possible until they think inflation is firmly under control. But I think in recent times we begin to see a little bit more balance in how they are doing things. Because at the end of the day, yes, you definitely want prices to be stable. You don't want the kind of instability that we've seen, a couple of years ago. So that shouldn't be. But what is the point if inflation is so low and nothing is happening? No economic activity is happening. I mean, it doesn't help anybody. So I think it's an important balance. It's always where you move the needle. Some move it a little bit closer to the preference for lower inflation, and then some might just be little. I think if you look at the current the current management of the central bank, how quickly, since the moment inflation was clear that the inflation is quickly heading towards the target, how quickly they moved. I think at the September meeting, I was one of the people who were a little bit critical that perhaps it's too sharp too quickly. But it just tells you that look, either their forward-looking prediction is strong for them to say we are definitely going into the lower inflation and so we should do this. Or perhaps they feel that look, we've suffered for long. It's now time for us to release the handbrake for economic activity. So it is a balance that every central bank thinks about. Some are extremely highly risk averse to inflation. And it depends on your history. If you take Germans, anybody working in the German central bankers, because of the hyperinflation they had before. So that history plays an important role in terms of how quickly they were asking even the smallest change in the risk of inflation. But I think in the main, it appears that we are currently in a regime that perhaps has moved the balance a little bit towards the middle.
Okay, I was just going to ask you that since you said you can freely express your opinions. So do you think that the current inflation targeting band is fit for purpose?
It's interesting you ask that. I think just yesterday at the MPC, somebody asked the government whether it is time for us to change our medium-term target band. This had come up before, actually. I think during the previous, Dr. Addison time, that came. And then he sounded more optimistic about maybe moving the band. Yesterday, the response of the governor said, maybe not so fast. And you should understand that. You see, if you look at our inflation history, the history of our inflation, especially since the 1980s, we've mostly lived in double-digit inflation, generally high. So when you have that, it's difficult to say let's send our band to say 3 to 5 or 4 to 8 or something like that. You have to get to an extended period where inflation, we have had low inflation. So if, for instance, we had up to 8 for say a year, then you realize the expectations will adjust. Then it might be a signal to you that perhaps it's time to move the needle a little bit downwards. But I think for now, perhaps given that it's only 2 years ago that we were at 54, maybe let's keep it where it is for now.
So you think it's fine? It's fit for them. Okay.
So, interesting, because inflation expectation. Just yesterday or day before, I was watching TV and a journalist was interviewing a former president of Ghana and made reference to inflation coming down from 30s to 8%. And he asked the journalist, how long did that take? He said, oh, just about 10 months. He said, okay, let's see how long it's going to stay. So the expectation is still there that we are not there yet. The expectation is even more important than the reality. Because people act according to their expectations.
Thank you. I think that's a very important the point that you've raised as well. Thank you so much. Okay, so I'll move on to Mr. Mensah. First of all, I want to find out if you believe that the economy has, or the structure of the banking sector has a high exposure to government securities, and if private sector lending is limited. So you can express your view on that. And then secondly, let us know if that is a barrier to effective monetary policy transmission.
Thank you. So currently, if you look at the bank's balance sheet, okay, you may be tempted to think that they are highly exposed to government. In other words, they've invested more into government than the private sector. But if you look at data critically, you will actually see that the banks have quite an allocation to the private sector as well. Okay, so it is not generally true that banks don't lend to the private sector. They do. Okay, maybe the quantum we can do better than what we are currently doing. But let nobody deceive us that the banks will stop lending to government by way of what? Investment in government securities. Banks will continue to do that because of the way liquidity management is done. Okay? In liquidity management, you need a portion of liquid assets you can easily change into cash. So that, like one of the panels said, if you bring your money to the bank, you come for your money the next day. Meanwhile, the bank has already given that money out as a loan. Now, where would the bank get money to pay you? Okay, sometimes they fall on their assets. If you have given all the monies you brought, if they've given it all in terms of customer assets, you can't go and sell customer assets and realize cash straight away. But if you have invested a portion into Government of Ghana securities, there is a secondary market, and you can easily go to the market and go and sell that particular paper and then realize cash, so that you can be able to use to support your liquidity management needs. And therefore, banks will continue to invest into Government of Ghana securities. Okay. Government of Ghana securities also serve as what? A safe haven, because it's less risky. Apart from 2022, what we saw, it has been less risky. So, in that manner, in times of high risk, banks will want to put a lot more of their assets in government securities because they know that the government will eventually pay them. And in terms of when interest rates comes down and the economy has stabilized, they now try to go into the real sector of the economy. So we will go there once we are on the trajectory of getting into a stable economy. You will see a lot more banks chasing you for a loan. Come for loans. They will actually call you and tell you that you qualify to come and take this particular loan. Just be on the lookout. When you finish school, you will see, we will chase you and ask you, come for loan, buy your dream car, buy your dream house, because we know interest rate is low. Hopefully, by that time, our inflation is still 6% and our interest rate is around 12%, so that you can come and borrow for your needs. Okay, so the current structure, the next question is whether it supports monetary policy transmission or not. It does. It does. Even though we have less than 30% of our assets, commercial bank assets, into the private sector, it's still quite a chunky of their assets. What it means is that 30% that we give out for private sector lending, okay, still serve as a tool through which monetary policy is transmitted onto the ordinary person. In other words, once policy rate is cut, there is a channel through which the ordinary man or the ordinary person on the market will feel it, because if you have gone for a loan, your loan, the pricing on your loan will reduce, and therefore your payments will go down. If you are, or if you are looking for a loan, you could also go to the bank and take a loan at a much cheaper rate than previously it is. So yes, the banks at the moment are doing just that.
Okay, thank you so much. You mentioned that private sector lending is about 30%.
Just about 21% thereabouts.
Okay, do you know the percentage that goes to government securities?
It's also around the data I've seen is hovers around the 25 to 30% thereabouts.
So they're not much different.
There's not much difference, okay? It's just that we need to be careful when we say that the banks only lend to the government. No, they do. Just that sometimes where we have got, where we have come from, if you have inflation at 54%, you have what we call exchange rate depreciating at 30% in a year, and then you want to go and lend, you will go and bite your fingers. You will bend them. You will bend them very much. So you want to take your time. You want to be cautious when you are lending to the private sector. But I can bet you that where we are getting to, most of the banks are going to aggressively grow their customer assets, and you will see that the private sector lending will go up.
Okay, I think that's good news. Thank you so much for your response. I'll move on to the next question, Mr. Hassan. And we're talking about expectations. I think you mentioned that the expectation is even more important than what's currently existing. So how do our expectations when it comes to exchange rate and FX liquidity, how does that shape the bank's pricing of loans, even when the policy, so keep the policy rate constant, even when it remains unchanged? How does FX, the expectations of FX movement affect bank lending rates?
Well, thank you very much for this question. Assuming monetary policy stays the same, then we all expect that exchange rate is going to spike for whatever reason, because we are living in an economy that is a primary commodity-driven economy. You know, once we expect exchange rate to spike, what comes to our mind is inflation. If inflation also spikes, as my brother just said, what's going to happen is companies, individuals that took loans may struggle to pay. Okay? So banks will become very conservative. You will have to build in some risk premium. Some of them will not even want to lend. They will want to hold on their money onto their chest, or even put it in government security. So remember, the question you asked him, it's linked to this question. Why am I saying that? If your government, i.e. the one that prints your currency, who can print and pay you, is ready to pay you interest at a very high rate, what business do you have giving it to another person with all that risk? So if you foresee exchange rates spiking, it will discourage banks from lending. On the other hand, if FX liquidity is expected to be awash, like we found ourselves relatively right now. Remember a year or two ago what exchange rate was doing. You can tell what interest rates were then. Banks were not lending, interest rates were high, now that we have some healthy reserves as a country and the exchange rate is stable, we expect it to somehow be stable into the foreseeable future. You see interest rates coming down and banks' appetite, as in this city, will start chasing you guys to come and take money. We just send you a text message and tell you that you qualify for loan, you know. So it's as simple as that, you know. Exchange rate feeds into interest rate feeds in a country like this.
Okay, so just a follow-up on that. So do you believe that FX volatility is a bigger driver than the policy itself?
I think so. I think to a larger extent, because Prof did mention, and you asked the question, inflation targeting. The central bank's key objective is price stability, inflation. Okay, so if exchange rate is the biggest driver for inflation, then the central bank, FX stability should be the main thing, followed by any other thing you can think about.
Okay, that's interesting. Thank you very much. Okay, so Prof, I'll move back to you. And we're moving into fiscal policy now. So in terms of how does fiscal policy, that is the scale and the timing of government borrowing, how does it complicate or limit the MPC's ability to manage interest rates effectively? So we're talking about monetary policy fiscal coordination.
Yes, and I think coordination between the two is something that we've heard a lot in the last 5 or so months. That's because of what happened before. Look, the mandate of the monetary policy is clear. Price stability and, in some sense, to a lesser extent, growth. Now, what government does with its finances, that's a big impact. So fiscal policy really is about what government is doing with its finances, borrowing and spending and revenues. So, because when government spends about its revenue, you have to find ways to finance it. So, how it does that financing has a big role on how the ability of the monetary authority to perform its function. Because the government is the biggest buyer in the economy. And the government also, in some sense, if you treat this as one individual, is the biggest borrower in the economy. So when it keeps its house in order, then it allows the monetary authority, it makes it easier for them to control what they are doing. Sometimes what you don't want is that the monetary policy is trying to do something and the government is doing something completely opposite, as we had before. Then when it also happens, then it comes down to the extent to which the monetary authority is able to stand its ground. Because if government wants to spend money it doesn't have, and the private sector is not lending to the government as much as it wants, and it cannot borrow abroad as much as it wants, which is what we had in 2022. Then what else? Who is going to fund it? So in that case, the central bank funded the government, and we know where it ended us. So I think the ability. So there's every central banker. You always find it helpful when the fiscal authority is keeping their house in order. It makes it way easier for you to do your work. But even if it's trying to play some riff-raff stuff, then what becomes important is how strong, and by that I mean how you the ability of the monetary authority to stand their ground. Because if we are talking about coordination because it's working for the better side, but don't forget that it's one side of the coin. The coordination can easily flip to the other side, where the two of them work in cahoot and move us to the direction we don't want. So I think it's definitely because they are both trying to achieve the same objective using different instruments. So what you don't want is one pulling left and one pulling right. So you want the government keeping its finances in order so that it support the ability of the central bank to keep the environment stable and promote growth.
Okay, and as usual, I'm going to ask you your opinion on this one. So do you believe that fiscal dominance is still an issue in Ghana today?
It's probably a lesser issue than it used to be a couple of years ago. I think, so let me backtrack a little bit. In the current regime, where we are now, there is not even much room for the fiscal to dominate the monetary so much. Because we are under IMF program. There's a stricter law on how much the central bank can finance. Now there's zero financing. It's not allowed. And of course, we've also done our DDEP, and we've done things that has really kind of restricted the government. So perhaps we really find out the true test will come when we are outside the IMF program, and government cannot raise as much, and they still want to spend because maybe an election is coming. That's where we see whether the monetary authority will stand their ground, and that's where we really find. So at the moment, yes, the dominance seems to have abated, but we have to understand that there are some external environment that is contributing to that. Let's see when we are on our own, and there's no restriction from anywhere, how much we'll be able to stick to that.
Okay, thank you.
Right now, if you look at things, we can say there's even monetary dominance. Because think about it. Only recently, the past 4 auctions or so, it's been underperforming. Government comes, I want to borrow 6 billion this week, I get only 3 billion. Why? Because banks see the monetary policy rate through the HOMO so attractive. So we all park our money there and leave government trying to fund its position. You see, so the monetary authorities have dominated now. But to Prof's point, let's close the door to IMF and see what happens, whether somebody will capitulate or not.
Okay, thank you. I think we are not doing too well on time, so I think I'll just do 2 more questions to our panelists, and then we can wrap up the discussion. So let me take it back to Mr. Hassan. I think you mentioned external factors when we were discussing monetary policy. So to what extent or to what degree do you think that our interest rate dynamics in Ghana is driven by external factors like global inflation, the US Fed decisions, and then other commodity prices?
To a very large extent, I would say these are the dominant factors of interest rate in Ghana. Think about it. There's a saying that when the Fed coughs, the rest of the reserve banks will catch cold. So the Fed raises interest rates because their inflation is high, and you see there's FX outflow in Ghana. Why? Because investors that were coming to Ghana with their dollars to invest, they borrow over there, and when their cost of borrowing goes up, those who didn't come cannot afford to borrow and come and invest here. Those who are already here probably will want to go back and enjoy the higher rate. So it triggers FX issues in Ghana, and then interest rates will follow. Same thing, commodities. We are a commodity producing country. Gold, cocoa, oil. If there's a commodity price shock in Ghana, like now we are enjoying gold prices. Let gold prices plummet and you see what will happen. Let cocoa prices plummet and you see what will happen. Interest rate will spike. Okay? Same thing, global inflation. Ghana is one of the smallest countries that is quite exposed because we are a free economy. Yet we are a primary producing country. We don't export, finished goods like that. We are just exporting primary commodities. Yet we've opened our economy widely. So any little spike on the global politics or economy, it affects us so dramatically. So for me, to a larger extent, not even in domestic factors, these external factors influence interest rates in Ghana much more. Think about the early 80s, what happened? Even recently, Russia, Ukraine war, and we are struggling. So for me, that is the biggest driver of interest rate than domestic factors.
Okay, thank you. Thank you so much for that response. And then finally to Mr. Mensah. Okay, so your question is, how can the MPC's interest rate decisions be used to strengthen the stability of the bank balance sheet? Since that's your area. So in terms of funding costs, liquidity management, asset quality, how can the decisions taken by a monetary policy committee be used to strengthen the balance sheet?
Okay, thank you. For any balance sheet manager, they are interested in liquidity. Number one, are interested in interest rates. Okay, number two. So when the monetary policy rate changes, it affects the bank's balance sheet that much. And one of the ways that it does, it triggers the effect has to do with borrowing costs. If the monetary policy rate comes down, it means that interbank rates will also come down. Cost of funding become cheaper, and therefore the banks can now borrow and support the real sector activities. Okay. Number two, it has to do with what? Liquidity. When monetary policy rate is cut, as it was done yesterday, and what it just triggers in everybody's mind is that now cost of funding is cheaper. It means liquidity is becoming what? Available. Okay. People can now walk to the bank and borrow cheaply. Now, when they borrow cheaply, what does it mean? It means that they will have the capacity to pay. So asset quality will improve. Okay, asset quality will improve. If the monetary policy rate is high, then the commercial lending rate will also be higher. They will then limit the ability of those who have borrowed to pay. That will increase impairment. When impairment goes up, it means bank's capital is the one that will suffer. So you see how the whole thing is linked. And so once the monetary policy monetary policy rate serves as a signal, okay, to any balance sheet manager to know where they need to tighten up or where they need to loosen up. And I can bet you where we are getting to right now, managers like myself, we are quite happy. We are getting into a stable regime, a stable economy. Okay, I can sleep soundly and wake up and know that my balance sheet is still stronger, because when I want to borrow, I will borrow cheaply. When I want to borrow, I will not struggle to get the liquidity itself to be able to do. Customers will not come and take the money, and then I will hear that impairment needs to be taken because they have enough to be able to pay their money.
Okay, thank you so much. So, ladies and gentlemen, I think we have sufficiently unpacked the technical, the structural. I think we also talked about the political and the future of monetary policy. So please join me in thanking our panelists for such insightful perspectives. Thank you so much. Do we have time for some Q&A? Okay. All right. So I think it's time now to open the floor to you. Okay. Yes, so now the floor is open. You can come up if you have a question, and please keep it brief, and you can also indicate which of the panelists you're directing your questions to.
Good evening. Thank you very much for the question. Please, when Mr. Mensah was speaking, thank you for the opportunity to ask. When Mr. Mensah was speaking, he spoke about the salary flow being a security for banks. So they are going to use the reference or base system for those that have their salaries flowing through the banks. However, those that are entrepreneurs are going to have the premium charge rates, right? So I want to ask that if they pay the premium before they get, the loan, after they pay their loan, are they going to be paid back their premium, or it's a loss for them just because they are high risk?
Okay, I think.
Maybe we can take two or three.
Okay.
Thank you very much. So I have only one question here. And the question is, what factors does the Monetary Policy Committee consider when setting the interest rates? Thank you very much.
So let me try to, I get your question. Okay. So the question generally is this, that if somebody walks to the bank and it's the first time borrower, and the person has to pay a high premium. Okay, would the bank unwind that premium and give it back to the person? No, we will not give it you cash. Okay, but what we will do is that if the bank perceives you as a high risk borrower, the first timer, and say maybe we charge you a premium of 500 basis, maybe 5% on top of the Ghana reference rate. Okay. Next time, if you're able to pay the first loan, now we have a history of you, that you are actually a credible person, you are honest, you don't default on your loans. So we will now, when you come for the loan again, we'll now say that the premium we charged you earlier is higher. Therefore, we will now charge a lower premium for you. Do you see that? So we will charge, maybe if it's 5% previously, we will just look at you and say, okay, now this client, he took the last loan 5 years, he has paid everything. He never defaulted for once. So now we know that you can pay your loan. So we'll take 2% for your, you see that? I know you want to go into entrepreneurship. Please.
So to add to that, I think Prof is here, he's an academic, and he probably would have to go and get some of his students to do something I'm going to talk about here. It seems to me that scenario is a self-fulfilling prophecy. So I'm an entrepreneur. I don't have salary which you can rely on as collateral as a bank. Because of that, you charge me a higher interest rate. You are setting me up to fail in the first place. Because this guy's salary is passing through the bank, you charge him 17%. I don't have salary. You charge me 20%, 25%. What are you doing? You are setting me up to fail. And I fail. And so it's like, okay, these guys, they are not reliable. See, our system for lack of data is penalizing borrowers for nothing, ending up in NPLs. So are these NPLs being caused by this lack of data and proper credit system, or the other way around? I think we need to write a thesis on that.
Well, incidentally, my last PhD student actually did a thesis on that.
Oh, interesting. That's interesting.
Whether high interest rates self-select people who are not credit-worthy borrowers. So this was he did it for a small branch of a microfinance institution where they randomly assign the interest rate. So you take, after pre-approval, the interest rate you get was randomly assigned. And it turned out that after the random assignment, those who receive higher interest rates defaulted the highest. So there was 3 different levels of rates: low, medium, and high. And then you see that the highest repayment was among those with the lowest interest rate. Exactly what you're saying. So to some extent, yes. But that's what happens when the economy doesn't have a system for sifting to who is, because from the bank point of view, that's a rational response. If you come to borrow, I have no way of telling whether you will pay or not. I have to charge you the average. I can't treat you as a credit-worthy borrower. I have to charge the average. And then but what happens is that, accidentally, what you might do is that somebody who probably had a viable project at a lower interest rate, suddenly the project is no longer viable because the interest rate is high.
Yeah, I think more research must be done in this, because I think for what was done, it was a random application. So maybe, why don't we have it, maybe is it sector-based or some other criteria that we can use along those same lines so that we can clearly determine what those causative factors are. Thank you so much. Are there any other questions? That would be it. Oh, okay, yes, there was a question. I think Prof answered that, the very first question, but maybe you can just quickly run through, just give the points. Yeah.
So, just quickly, it's a balance between whether the central bank feels that there's a higher risk of inflation or there's a higher rate that growth will be slow. So, if it feels that if risk to inflation is high, it is going to raise the policy rate. On the other hand, if he feels that risk to inflation is subsided, but then you need to support growth, then to cut the policy rate. So really, that's what it comes down to.
Okay, thank you. I hope that answers your question. Is there a last one, or shall we wrap up? Okay, all right, please go ahead.
Yes, but this is really
Okay, thank you very much for this opportunity to ask a question. Well, my question is, since the loan premium on entrepreneurship is very high, don't you think it would discourage we the youth want to embark on entrepreneurship? So as a bank, is there a package for we the youth who want to enter into entrepreneurship? Thank you.
Please, you mentioned in your presentation that a trajectory of a stable economy will be a reason why the interest rate is low and the loans can be taken easily. So then my question will center on how we can ensure this stable economy, even as the banking system, to be able to enable the loans to be taken easily by those who actually need them. Thank you.
So the first questioner is asking whether those of us who want to go into entrepreneurship, there are packages for them. You know, so commercial banks are, if you like, commercial entities. We want money. But yes, banks still go the extra mile to encourage, especially in partnership with development organizations. So yesterday, this same time, I had a conversation with an entity from Germany called Finance in Motion. So this supports banks to lend into areas, women-led businesses, you know, entrepreneurs, and so many other impact areas, green financing and all sorts of things. So yes, don't be discouraged. Go into your entrepreneurship. You will definitely get support from banks, even if not on their own. As I speak, not to mention, not to be specific, we have a MasterCard Foundation that partners with a lot of banks in Ghana, including my bank, to help especially the youth and women. So where a bank will charge you 20%, they would lend to the bank and ask the bank to charge you not more than 10%, for example. So it's there. Don't be discouraged. You make the inquiry. You get the support.
Yeah. Yes, exactly as Mr. Alassane has said. So don't be discouraged. Okay, there are interventions. We are commercial banks, but sometimes we also know that to build a society, you may have to sometimes forgo some profit to be able to build a society. So MasterCard Foundation is one of the tools. When you want to, if you have a good, solid case, business case, and you walk to a bank and the bank thinks that they can really support you, I don't think you pay more than 10%. So even at that time when rates were 30% and above, banks were still lending to those guys at 10%. So come and lay down your problem, your case. You will receive help. Okay, the other question, somebody asked, how can we make sure that the economy is stable, isn't it? So that the loans, the rate on loans can be maintained at a lower rate. That's a monumental question. That one has to do with what we call those who are in charge of our fiscal policy, those in charge of our monetary policy. Okay, they've given us assurances. Let's just hope and trust that indeed a time will come, Ghana interest rate will fall to the level its peers are experiencing. Currently, our interest rate is around 20% on commercial lending, which is quite high. I know next month it will come down to sub 20, but it's still high because in some other African countries, people can walk to the bank and borrow somewhere less than 10%. Is it less than 10%? But it's a process of a long economic stability. Once we are able to enjoy that long stability, we will be able to also get there one day. Okay. Okay, so just rest assured, the managers of our economy are working very hard, and I know that some of them have really, their public conversations and the utterances they've made, they know that they need to keep to what they are promised, and I'm sure we will get to that level. Thank you.
So a quick one on that. How can we make sure our economy is stable, interest rates are low? A professor is here, but I'm taking leave from him to say that we've said it all here, which is to say we've always spoken about changing the structure of our economy since Gagisberg's time. We are see gold prices today. We are still exporting the raw gold. We don't add value. Cocoa the same, oil the same. If we had changed the structure of the economy today and become less vulnerable to these global shocks on these commodities, especially at this time when we have this windfall, use that windfall to try and steer the economy towards value add, to make us less vulnerable. Again, our government, I'm not talking about this government, any government, we run a lot of deficit. You and I, we don't pay taxes, so they have to borrow to be able to, execute the promises they gave to us, isn't it? So when government is ready to borrow so high, banks will not lend to you at lower interest rates. That's another problem. And then again, we've spoken about, we not knowing the collateral system, the credit system is messed up. We can't determine whether you will pay or not. Now we are having a situation where credit reference bureaus are coming in. If you see the rate we lend as banks to large corporates, you'll be surprised. They are enjoying very low rates. We lend to them at this same reference rate minus, with discounts. Sometimes we lend to large corporates cheaper than we lend to government. So we just have to change the structure of our economy, and as he said, our politicians are doing that. We hope eventually we'll get there, and then we'll be in a low interest rate environment, and everybody will enjoy. Right?
Let me add on quickly. So what can you and I do? So let's not think that the problem will be solved by only political leaders. There are things that you and I can do. You and I can start producing and adding value. And you and I can think Ghana, eat Ghana, and work Ghana. Don't forget that. I know it's easy for us to say, oh, the things from abroad are cheaper. Every time you can buy the Ghanaian alternative and you buy the imported alternative, you are shipping your own job abroad. That's what it comes down to. Every time we can buy Ghana and we buy foreign. That's what we are doing. So it comes down to hurt us in the long run. So let's add value. Now you see, like you said, young people, you listen to the kind of thing that they are doing in all different areas. It's amazing. I think we can do same, but also while others are doing, let's also patronize. Then we give them market, we support them, they will do well. The benefit will come to all of us.
Thank you. What was the question?
Yes. How does the MPC measure the inflation expectation to come up with the inflation targets, and whether the MPC can directly influence the expectations?
Good question. Let's start with the last part. The expectation is something that we all form, and a big part of it is what we have experienced. So if, say, for 2 years, inflation is between 5 and 6, you will learn to expect that that's what the inflation will be. If you have 2 years where inflation is above 30, that will seep into your expectation. That's what you work with. Now, how does the central bank measure it? Well, it conducts surveys of financial experts, some academics, and some business leaders. Because you see, when these people are making decisions, they factor in their own projection of expectation and they act on it. So when they do those surveys, they will tell them what people are thinking, where inflation is headed. So that's how they measure the expected inflation.
So I think it's quarterly or so, incidentally, where I sit in my bank, I answer those questions. So they send it, the Bank of Ghana, how do they measure inflation expectations? They will send the questionnaire online to banks and other entities, and we all fill in a whole lot of questions, including what we think about inflation in the next year or two. And they use that to measure expectation and then act on that in terms of monetary policy decisions.
Incidentally, I also get it.
Yes.
Myself. When those surveys are done, they will then now put it into a model. Okay? If you're interested, when you get to the Bank of Ghana website, they have a framework to forecast. They are forecasting tools. They have it there. There's a particular document. Okay, the models they have to use. And those models are actually tested by international institutions like IMF and World Bank, so that they give credibility to the models. You get it? So those models, they will test all of it, and then you throw a number to them that, okay, for the next 2 years, inflation is going to be trending upward. Based on that, they will tell you that, okay, no, we will cut the rate by 100 basis points, or we will increase the rate by 100 basis points in order to contain the rate. You see that? Everything has a driver. You know that there are things that drive inflation in Ghana. Some of them, you can mention it. Fuel price, exchange rate, depreciation. If the city depreciates, we will have imported inflation. You see that? So they will use those variables to do their forecast, and then it will help them to make a decision on the inflation, the policy rate that they will announce to the public. Okay, thank you.
Okay, thank you so much for all your questions. I think it has been a very interesting discussion. So thanks everyone for your excellent and thought-provoking questions. For me, my key takeaways, I think, from this conversation has been that understanding interest rates is more than just numbers. It requires context, it requires clear communication, and also requires strong collaboration across all our financial institutions. And I like the last point that Prof mentioned, that let's all contribute to add value so that we change the structure of our economy, so that we are not exposed to all these external shocks that will cause the rates to go higher than we expect it to go. So let's all play our role to contribute to our economy. So let me once again thank or extend my sincere appreciation to our panelists, Professor Patrick O. Asuman. I'm told I addressed you wrongly, you're a doctor. So sorry, I can't refer to you as Mr. Emmanuel Mensah. He's actually Dr. Emmanuel Mensah. And then we also have Mr. Hassan Musa from Stanbic Bank. And thank you all for your insights. And to all of you, thank you for engaging with us so thoughtfully. So at this point, I think I'll say thank you, and I'll hand over back to our moderator.
Thank you so much. Please, let's put our hands together for that. Thank you so much, Nana Fimba, and our very excellent panel. That was so insightful. We have learned so much, and I think the feedback through our questions too have been very, very excellent. I think majority of us here are students of financial services regulation. That's one of the courses that we do here at in fact, we are the only law school in Ghana that does that. Financial services regulation. What we do is that we assess the legal and regulatory framework for the 4 sectors within our financial sector. So not only banking, insurance, capital markets, and then pensions. We are the only law school in Ghana that does. So these are future regulators, policymakers, in-house counsel, academics, and so on and so forth. So at the right time, when we approach you, by which time, there'll be lawyers and what have you, I'm sure you remember this discussion, and you warmly welcome them into your various institutions. At this point, we want to call on our Vice Dean, Dr. Francisca Busiapia, to share some thanks with all of us. Please put your hands together.
Hello, ladies and gentlemen. Thank you so much, first of all, to Nana Fimba. It's been, I think, over 20-something years the last time I saw her. So it's great seeing you again. She's looking more pretty. Thank you so much for steering the affairs. I was at the back listening initially because we had some meetings and then I didn't want to interrupt, so we stayed at the back listening. You've done a great job. And of course, to our panelists, to Prof, Doc, and Mr. Thank you so much. Indeed, you have done justice by demystifying interest rates. So I'm sure right now everyone understands why we have certain rates, okay? How it's calculated, as I said, there's transparency, you can read. It's all available, the information is there. And most importantly, what is said, okay? Let's add value. We are a resource-rich country. Let's add value to our resources so that at least the banks are already willing to modify their own measures and mechanisms to invest in entrepreneurs so that we can make this country great and prosperous. So thank you very much to the wonderful panelists and of course to you as well. Without you, it wouldn't have been possible. And we have to thank Absa Bank for making this a reality on a quarterly basis for us to be here. So, thank you so much, especially to the organizing team. You've done wonderfully well, as usual. And of course, to our media team, thank you so much. It's been a pleasure. And hopefully, please, the takeaway, make sure you took down notes. They may appear in your exams. Thank you very much.
Thank you so much, Doc. Please put your hands together for Doc. Doc, if you don't mind, kindly stay there for just 2 minutes for us. We want to show our appreciation to our panel members for taking time off their very busy schedules to join us for this discussion. So in no particular order, we want to first invite Mr. Alassane Musa to take this token of our appreciation, please. So,
thank you very much.
okay, next we'd like to invite Professor Patrick O. Asuming. And then Dr. Emmanuel Mensah. Hey, which one is the last one? Right, go for it. And then to our very articulate, lovely and very, very intelligent moderator. Doc didn't tell you that both of them, the important part, I left it out. Gay. Oh yes. I'm sure you took notes of how articulate she was. Yes. She's a product of Wesley Girls. Yes. This one, very important picture, Thank you so much. So let's like to take one final group picture with Doc and all our